TimingResearch.com, and I want to welcome everybody here to the first of number of broadcasts today. And before I get started, just a quick background. I'm a graduate of Boston College, and I've been in the investment business here for decades. And I've done hundreds upon hundreds of seminars, both live and online, in the options area. But I am familiar with all different types of investments, having been in the business for such a long time. With regards to today, what am I going to do? I am going to give you my observations, my opinions on a wide subject matter that I think many of you would be interested in. And I'm going to cover a lot of different markets. Some of you will be familiar with some, and it'll be news to some of you as well. Basically, the situation right now, let's be honest, we've got a very tough situation economically, and we've got a very tough situation on the employment front. So obviously 70% or better of the economy is consumer spending and consumer activity. And so obviously with today's report of 6.6 million or more unemployed, plus last week, we're at 10 million unemployed in 14 days. And I think that's not even a current number. So what you've got to say to yourself is how is that going to affect things like earnings? Now, a lot of people are bringing down their earnings estimates. There used to be $1.75 on the S&P 500. Some are down at 115. If you give a 15 P ratio to 115, you're at about 1875 on the S&P. Some people think that we're going to be able, because interest rates are so low, we're going to be able to live with a higher P ratio. So that would bring that S&P number up. My thing is, listen, we don't even know what the E is going to be, so this guesstimate estimate stuff might be not worth the paper it's not written on. So I would be very careful putting too much weight into estimates when we have absolutely no idea what they're going to be. Just a brief background. Again, I send out a weekly market update, and I cover a whole bunch of stuff. And so, at the end of the broadcast, I'll explain how you can get into the queue on that. But I'll give you a background on what I've been thinking. On the S&P, we ran up to, we had a ceiling at about 3050 on the S&P. For some reason, in January and February, probably to suck in all the pension plan money and all the people who buy strength, the market ran up to 3,400 almost in January and February on a very, very big move. Based on what? The earnings weren't growing at all. 2019, last year, we had no earnings growth to speak of. So why the heck did the market go up? And then, of course, with the GDP is nothing to write home about either. So you didn't have much GDP growth. You didn't have much earnings growth. So I really thought anything above 3050 was a joke, and it actually turned out to be a big joke. Now, the thing here is how did you get up there? Well, you got up there pretty simply because companies were buying back their own stock, using their cash, not for capital equipment, not to increase wages for the grunts, but no, to buy back their own stock. And then they went out into the debt market and they borrowed money. And they borrowed money at low interest rates. And basically, they took that money and they bought their own stock back too. So now they spent their debt money and their equity money on buying their own stock back. What happens now is the wheels of change start blowing. And obviously, even if we didn't have a pandemic, a slowdown was probably in the cards because Japan, after their VAT tax in October of last year, was in the tanker. And of course, Europe's been in the tanker so long, they just live in a tanker. So the bottom line is that the idea that this virus has caused all of this is really, I think, unjustified. Now, again, when you start coming down, and I've said this all along, these ETFs are wonderful, except that behind the curtain, those investments aren't liquid. In other words, they are deluding people to think when they buy a bond ETF or a stock ETF that it's some kind of a liquid deal because they give you a price on the screen and you can buy it, sell it at a stock. That's good when you're dealing in passive investing, which is what? Where people invest and do nothing. They sit there like Buddha and they think the prices go up. And obviously the prices did go up for 3-4 years, right? So sitting there like Buddha was a good idea. But what happens is when people want out, and I've said this for a while, well before it dropped, it's not going to end well. Why? Because when the whole movie theater is full and somebody yells out fire and they all want to get out and there's only one door and you got 9 million people trying to get out one door, it's not going to work. So that's basically what occurred during this drop. We had a liquidity crisis. We don't have a credit crisis right now, although we may, because defaults are going to rise. But we did have a liquidity crisis. And, when you're dealing in bonds, okay, that's not on the exchange. That's through dealers, meaning, people's trade desk, right? And if the dealers see an avalanche coming, a tsunami of selling, they're not going to take their checkbook and throw it into a burning building. and let their money go get burned up. What they're going to do is what they did do, and that's they stood back and made no bids, and ergo you had no liquidity, and they wait for the Fed to show up, which they always do, with their printed money out of thin air. Because if anyone's going to burn through money, let them burn through their own money that they just created out of thin air, not the dealer's money that they've worked on and they've had to collect, and it's their money. So basically, that explains why we had the liquidity crisis, because you have a ton of selling into a no buyer environment in a bunch of illiquid assets that were running around masquerading as liquid assets. So that should give you a little idea on why we ran down to 2174 in 19 days, which is, or wherever we went in 19 days, the fastest bear market in 19 days. I mean, the Great Depression took 42 days. This has took 19 days. If we did have the strongest economy in the history of the planet, as people are promoting out there, why can't we take 1 month off of cash flow without collapsing the system? Because the system is built on debt, on top of debt, on top of debt, and on top of debt. Now, whether you be an individual, a government, or a corporation, if your entire structure and history is on debt, and now what are they doing is they're piling more debt on the debt problem to try to get out of the problem. So it's almost like drugs. You know, if a guy's on drugs and then he gets, he gets no more drug, his body is going to start freaking out. And then if you give him more drugs, he'll be okay for a while. But, this debt thing is like dope. I mean, they got to keep feeding debt in there. Everything is about debt. Come on down to the small business loans. Not only is your company not doing well, but we're going to throw some low interest forgivable debt on there, you know? So I don't know. I mean, to be honest with you, there has to be a line in the sand where debt becomes a problem. And again, the whole world is issuing debt like nuts. And, whether it be Europe, Asia, Latin America, the US, I mean, they are trying to solve a debt crisis with more debt. How's that going to work out? Well, it kind of worked out in '08, but we are so far beyond '08 as far as creating debt is concerned, it's a joke. So the bottom line is that, my feeling is that obviously the market has gone into bear territory, and with the VIX above 50, 60, 70, 80, whatever, as long as the VIX is above 30, you're in a dangerous area. So the bottom line is what I thought might be the best case scenario is a big trading range, where the top end of it might be 2850 to 3 grand, best case scenario, and the bottom might be 1800 to 2200, best case scenario. And then basically you go back and forth until what happens? Until the moving averages catch up with the price. Because realize all these long-term moving averages, which I might show you in a little bit, are way above the price. And, the market fell so fast, they're so far above the price, it takes time for them to catch up to the price. And the other thing is the VIX. The VIX, in this elevated state is very weird. And so weird probably means wild swings, which means you can walk in one day and it could be up 2,000 on the Dow or 3,000 on the Dow, and you could walk in and it could be down 2,000 or 3,000 on the Dow as well. So these wild swings are really not wild swings, because if you threw a ball off the Empire State Building, obviously the bounces would be very big initially. And that's basically what we're seeing here, very large initial bounces. Is most of the panic behind us and the forced selling? Well, we would hope so. But that doesn't mean you're not going to get further deterioration when people realize how many people are out of work, and maybe these small business loans don't go through that easily, and maybe these people are so sick of their business and now it's not doing well, they just close up shop. You don't know how it's going to pan out. And you also don't know how the 70% of the consumers are going to, how's consumer spending going to be? Are they going to just come rip their masks off like Batman and Superman and run into the malls like madmen? That might be a little optimistic. So the bottom line is we are a service economy. When you hear, oh, but China is coming right back to work again. Well, it's not. It's a lot easier to tell people to go right back in that factory and start making iPhones and televisions or whatever they do over there, right? And it's a lot easier to tell them just go back into that factory and get working, because they're a manufacturing country. But it's a lot more difficult to say, get out, rip those masks off, get out of your house, and get down to Olive Garden and start going out to eat again. Or go to the mall and start spending a bunch of money. I don't know how quick that's going to be. Some people think it's going to be very quick. Some people think in June it's going to turn around. Some people think by end of summer, and definitely most people think by Q4. That is possible. There's no question about it. But is it a little premature to ring that bell? I think until the VIX gets under 30, talking with confidence that the market is going to have a low in, I think might be premature. So if someone was asking me what would I like to see, the two things that I've been watching to give me, I'll show you one right now. The Dow Jones Transportation Average. Everybody likes to call it this archaic thing because it started in 1884 by Charles Dow, and it's like the first thing they ever came up with. So of course, in this modern society, it can't be relative anymore, right? Well, let me show you how relative it can be, because I'm going to show you why this is one of the indicators that told me that rally was a joke. And let me go back 5 years on it so you can see it a little bit easier. All right. That is one of the platforms I use called Big Charts. So you guys are out there looking for platforms, this is one that I like to use. All right, so anyway, can you see that we made a high over here in 2018, right? And can you see that we never made a new high, right? That's called non-confirmation. And everybody says, oh, it doesn't matter because in the modern society, we don't use those archaic things. Well, that archaic thing kept me at anything over 3,000 on the S&P. And it actually got me into a situation where I didn't want any part of anything. And that's a better place to be than riding the elevator down. The second thing that I found as a good indicator, and as you can see yesterday, it's given up the boat again. Is that the low right there? Well, you're going back 5 years, so you're back to 2011, 2016 or lower, right around there. So, it's definitely discounted. But of course it should be. 10 million people just lost their job in the last 2 weeks. So why wouldn't you discount valuation here? Okay, this is the Russell. This is the other one that told me that this was a Fugazi rally on the S&P and stay out. So let's take a look at here. As you can see, you made a high here in 2018, never made a new high in 2019, and obviously the lack of confirmation on both the Russell, which is small caps, and the transports kept me away from that S&P. And I'll show you the S&P, which was a sucker bet, and a lot of times it is a sucker bet, both on the up and the downside. I'm sure when we hit these lows, it's going to look like a sucker bet for the people who sell out, but I don't know when exactly that is, and nobody does. See, the S&P made this huge new high, right? Without the transport, without the Russell, and when that's why we're dropping so far. It was up to almost 20p ratio with no earnings growth from 2019. Talk about a come line bet, as they say in Vegas. What happens when you do come line bets and they roll a 7? They take a big rake and they rake all your money in. Well, there's the big rake between 3,400 and 2,100. Okay, so basically at this point in time, this market has actually been behaving fairly orderly from the standpoint of percentages. So I'm going to give you a couple of percentages that I'm looking at here. Let's see if this thing will behave here for me. Let's just look at, 6 months. 6 months. And it'll show you that we had a move from 3,400, I'm rounding it up, 3,400 down to 2,174, right? And that's 1,226 points, right? So you take 38.2%, one of those Fibonacci deals, and you put on about 470 points. 2174 plus 470 takes you to about 2644. You see that high that we just hit? That's right about there, okay? So that's basically why that's the resistance zone initially. If you go up further, 2850, that number there should be a resistance zone. And then if you take the differential, 3,400 S&P minus your 2174, you times it by 61.8%, that's 757. 757, tacking on your 2174, that brings you to 2931. So there's your three resistance zones on the rally, okay? 2640, 50, we just hit it. 2850, which is that low there. And then the Fibonacci 61.8 is 2931. So if you want 3 resistance points, those are 3 right off the bat. All right, let me give you an idea on the pullback, okay? The pullback, we went from 667 in 2008 up to 3,400, and that's 2,733 points. Okay. If you go 38.2, you get 1,044. So 3,400 minus 1,044 takes you to 2,356. That broke through. Okay, so that's already broken. If you want to go to 50% correction, again, 3,400 minus 667 is 2,733. Divide by 2, 1,367. 3,400 minus 1,367. A 50% correction takes you down to 2,033. That's why a lot of people are using that 2,000 number. And then finally, if you take your 2,733 and you times it by 61.8, you're looking at 1,690 about. 3,400 minus 1,690 takes you down to that 1,700 area. So that's where they get those kind of numbers, and that's what people are thinking. So, basically, if you're a believer that 60%, like the drop we had in 08, is as bad as it's going to get, which I think is a big if, but it is possible. Then your three levels where you might want to take a shot. One would have been that 2,200 we just saw. The second one would be about $2,000, and the third one would be about 1,700. If you want to operate under the idea of 38.2, 50%, and 61.8. Howard Marks of Oak Tree Capital, is a distressed buyer. His company is distressed debt buyers and stuff. And he made a good point, a rational point in my view, in that, if there's a 60% chance that we're going to go lower, then obviously you wouldn't want to spend all your money at one level. You'd want to have some money hedging the fact that 40% is that the lows are in. So the bottom line is that's where some people are thinking dollar cost averaging is not a bad way to go. That's putting an awful lot of faith into the idea that we're only going to go down 60% because history tells us that. And, sometimes people say history doesn't repeat itself, but it rhymes. But that's not always the case. There is no absolutes out there. So you have to, obviously match it up to your risk tolerance and, your circumstances and all that kind of stuff. But I'm giving you some parameters because obviously, you just got thrown off the boat in the middle of the ocean and you're trying to get your parameters on, where the heck land is. And nobody knows where land is because you're out in the middle of the ocean here. Obviously, 10 million people losing their job in 2 weeks is uncharted territory in this kind of a speed. I think that 24% was the unemployment rate in the Great Depression. So, I don't know what this unemployment rate's going to be, but it's got to be looking somewhere near 10 or 15 pretty quick. And that's, and that's if we don't get further deterioration. So bottom line is like I say, I'm going to be going over some different things here on the stocks, on opinions that I have, and of course, observations I'm making, which I'll get to in a minute. But I want to give you a little bit of an idea because there's, obviously there's a lot of people out there. Should I hold? Should I sell? Obviously, well, I might as well get into this right now. What you could do when prices are high, which is something that I was, talking to people about and inviting people to ask me about, is how do you reduce risk when the prices are high? Obviously when the prices are high, now how do you know they're high? Well, if the darn thing's at 3,400 and it used to be at 667 10 years ago, and it used to be at 2,000 4 years ago, and the former double highs were at about 1,600. You don't have to be from Harvard to figure out 3,400 is kind of high, right? So basically, a lot of times you don't want to get out when the prices are high. So you have to look at for different ways of reducing risk. And I'll give you a couple of them, right off the bat. One is called a collar strategy. Now, say you had Boeing up at 460. And I even talked to people about this as an example. Now, this is just a theoretical example of commissions and fees and spreads and everything else is not in here. I'm just giving you a ballpark, shall we say, theoretical example. You got Boeing up at 460, right? And say you're concerned that, obviously it's had a big move and maybe the 200-day moving average is at 310. That's another indicator that you're way overbought. Just like right now, we're way oversold even though we're still down here because the moving averages are way up in the higher levels. I'll give you, for instance, here. Let me go into the detailed quote here and see if I can give you the 50-day and the 200-day on the S&P. Okay. Now, yeah, you're at 3,024 on the 200-day, and the darn thing hit 2174. Do you have to go to Harvard to figure out you're oversold and it's going to snap back? Use your common sense, and your 50-day average is still at 2986. So this thing is still way, way, way oversold, and for good reason. But it is oversold technically. With regards to the getting back to the example on Boeing, say it's at 460, and you go, you know what? I'd like to, for 6 months, have some kind of a hedge on this thing. Well, what could you do? Well, you could go out and look at the out of the money call, see if you get a little bit more appreciation. Maybe you look at the, 500 call, and let's say you put it in there and it goes for $5. Okay? You take that $5 and let's say you bought a 400 put or a 420 put, let's say, as an example. Now you pay $5 for that, let's say. Okay, you got to crunch the numbers. The numbers are not always going to be equal. I'm giving you a theoretical, conceptual example. So now you have the obligation to sell Boeing at $500 if it gets there. Plus you got the $5. But you're going to take that $5 you received and buy a put at 420, which puts parameters on your equity. And I think you want parameters on your equity. Obviously you don't want your equity all over the place. So the bottom line is in this example, you've got upside potential of another $40 in Boeing to 500, but you've got a floor at 420 until the options expire. Now, let's say during that time, Boeing goes down to, like it did, 120. Well, rather than having a $300 loss on Boeing from 420 down to 120, you've offset that risk. Sure, you've lost the difference between 420 and 460, but you're in a heck of a lot better shape than the people who are trying to swim down here at 120, 130, 140. Okay? So, again, I'll give you another example on why a stock like Boeing, might have snapped back. Boeing went to $89 and then it went all the way back to 180. It doubled in price here in the last month during a bounce back rally. Well, let's just see what the 200-day moving average is on Boeing, and you get an idea why that probably happened. The 200-day moving average on Boeing is at 327. When it goes to $89, it's $227 under its 200-day moving average. You do not have to be a genius to figure out that if it has any good news other than they're going out of business, it's probably going to get a little bit of a pop. And so basically that's what it did recently. So, but you can't look at that pop as some kind of a good deal because, again, if it's made out of short covering and spec ends, it's going to fall under its own weight, which explains why it goes from 180 back to 130. But there is a line in sand that's been made on many companies, and that's obviously the low that it's made. So again, one way of reducing risk is using a collar strategy. And if you don't know how it works, talk to your broker, talk to your advisor, and see if it's right for you, because there's other aspects to consider, like taxes and this and that and the other. So, but this is the basic strategy on how to try to protect equity. The other thing is asset allocation, okay? And I'm going to give you a little bit of thing here. Now, when I reference any ETF or mutual fund, I'm not recommending them. I'm just using them for illustrative purposes only. But, some of the ones that I watch, I'm going to share with you now. And let's just get this thing here real quick. And it's asset allocation. People put a certain amount in stock and they put a certain amount in bonds, right? It's called an asset allocation. Well, when you go up to 3,400 and you've made a ton of money, and your asset allocation is 20% bonds and 80% stocks, you've made a big hit. But if you want to ride the elevator up and ride it back down, then don't adjust your portfolio. But if you want to, adjust your portfolio to reduce the risk, you can go from 20% bonds, 80% stock to 80% bonds and 20% stock by using some of these mutual funds or ETFs that are set up that way, where they use bond indexes to give you your bond portfolio, and they use stock indexes to give you your stock portfolio. So for instance, Vanguard, and again, I'm not recommending any one company or anything, it's an illustration. They have a they have an 20% stock, 20% bond, 80% stock. It's a VASGX. Now, this is an aggressive long situation, which you'd want to not be in at the top, right? And to give you an idea, I'm showing you basically what the drop has been. Now, till yesterday, that drop from 37 down to 28 is about a 23% drop in equity between the high and yesterday's close. Obviously, it was a lot worse when it was down at 26.53, right? But it was down 23% even yesterday. So if it was at the low there, it might have been 30% down, okay? Now, what if when the market was high, a guy said to himself, why don't I've been in this 2080 a long time. I've made a lot of money here. I think I want to, reduce my risk. So you go to 80% bonds and 20% stock by going to VASIX. Now look at this. Okay, on this one, you've gone from 1658 to 1540, 54 as of yesterday. That decline is only 6% about. That's a lot different than 23%, right? So the bottom line is by adjusting your asset allocation, and this is what I try to tell people to look into, investigate it, get comfortable with it, so you can move your money around based on where you think the market is and what your risk tolerance is and how you think things are going. But again, those are two very fundamental ways of trying to reduce risk when you think it's a time to do so, or increase risk. Now we're down in the 2000 area. Maybe if you were in the 80-20 up at 3,400 and you go down to 2,000 or 1,800 or 2,200 and you think the lows are in, what would you do? You'd consider changing your asset allocation, maybe back to 2080. So anyway, that's one way of doing it, and it's a one-stop shop when you do those type of instruments. I didn't say it's the best way. I'd say it's one way. All right. One other thing I wanted to bring to your attention here before I go through some other stuff is, what do you think with the VIX this high, put options are doing? Put options are very, very high. So you may have a bunch of stocks you like, but not really sure that you want to buy exactly at this price. So what you might do is look to put writing. Now, put writing on a fully paid basis means this. It means you have in your account enough money to buy the stock if it's put to you, and you have 100% equity in it. So if they put stock to you, you're going to be able to buy it because you have the cash reserves right there to buy it. So this is called a fully bought put, shall we say, or you have enough money, a cash put, because you have the ability to buy the stock if it's put to you. Let's say you're looking at Boeing, okay? Boeing obviously has a lot of bad news out there, okay? Why do you think the stock goes from 460 down to 89? Now you say to yourself, are we going to be going out of business on Boeing, or is this 89 a decent price? Well, say you go and say to yourself that between now and the end of the year, you think Boeing will bottom out and turn around. That's your statement. And you'd like to try to pick up stock down here, but you don't want to buy it at 130, and you don't even want to buy it at 89 bucks. So you look at the puts, and the December puts. This is a example again, although the prices are somewhat near what they were at yesterday. But again, this is a theoretical example. But the prices I took off the screen from yesterday, ballpark. All right, so the 65 puts, the low is 89. The 65 puts for December are going for 10. What does that mean? If you sell the put at 65, they pay you 10 bucks for every 100 shares. So what's 65 times 100? You're signing up for $6,500 worth of stock. You have to have 6,500 bucks in your account to buy the stock if they put it to you, right? Which means they deliver it to you at 65 bucks and you got to pay 6,500 for every contract. Now, you got 10 bucks in your hand. You can either keep the 10 bucks or you could spend the 10 bucks. Now, if you don't spend the 10 bucks and you keep it, you take 65 bucks where you're agreeing to buy, You take 10 bucks off because that's the premium. So you're actually trying to buy it at 55 bucks. Right? Right. So if you keep the money and don't do anything with it, the result would be 65 minus 10 or 55. With regards to if you spend it, well, you could take that money, and if you think you want to buy a call with it on one of the other months, that's fine. Just remember that money was from the 65 put. So if you spend the whole 10 bucks, you're going to what? You're going to have to come up with 6,500 bucks, right? And then, of course, like if you don't, you can reduce that 65 by 10 bucks because that's what you receive. So that's, an idea of somebody who thinks Boeing might turn, but they don't want to buy it at 130. They don't want to buy it at 89, but they wouldn't mind buying it at 65 between now and Christmas or whenever that December goes off the board. Another one is Google. Let's take a look at Google. Some people think Google's a good company. They're sitting on a bunch of cash, so I think their balance sheet supposedly is pretty good. And it hit about 1,000 at the low, 1,015. And basically, if you go to September and you look at the 680 put, 680, would you be willing to buy it for 680? Well, what's 680 times 100? 68 grand? Right. So bottom line is you have to have 68 grand in your account to do one contract. And basically the 10 bucks would either reduce your cost from 680 to 670, or if you took the 10 bucks and bought call options or did something else with it, obviously then you'd have to be ready to buy Google for 680 bucks sometime or anytime between now and September, if they put it to you. Another one I looked at was Microsoft. Microsoft's at 150, or yesterday it was anyway, I think. And Microsoft is basically looking at, let's see here, 150. So the 100 puts for December are going for $5. You'd be willing to buy Microsoft for $100, or 100 minus 5 or 95. And that's, again, if you got delivered stock at 100, you have to have 10 grand if you're going to get hit stock on every contract. And Apple, just giving you examples here. Obviously, again, I got kicked out here. There we go. Apple's at 240. Would you be willing to buy it for 150 between now and January? I think January was the month. Well, you get paid $7 to do that. So 7 minus 150, you'd be a buyer at 143. Or if you spent the money on calls or something like that, you'd have to have 150 times 100 is 15 grand to buy the one contract that you signed up for. So that gives you a little bit of an idea of some things you can do when and if you think we're somewhere near the low. And you would like to sign up to buy some stock, but maybe not at current prices. You want to sign up at a discount to the current value, and you want to get paid a premium to do it. Okay.
Hey, Jim, just a reminder, they're only seeing part of your chart.
Oh,
right
okay. Now. Okay. Well, I'm sure everybody knows the Apple price, but I will try to get the thing more centrally located there. Okay. So that gives you a couple of different ideas now. I'm going to go over to Google and get some stocks going here on different areas. Because, if you're trying to see, where you might want to look at employing capital, I'm going to go over some different areas that I'm looking at. Okay. First one is 5G. We know a lot of the players, and some of them you don't know. Apple is one we just talked about. Verizon is another. Get a look at where the prices have been over the last 5 years. And you can see that, the price right now down is at about $50 or so, ballpark. And that is about as low as it's been since 2018. And this thing pays $457. So Verizon would be one to look at for the 5G. Qualcomm, Their CEO was on TV saying that in China, the manufacturing part is going smoothly. So the only thing is when demand comes back, Qualcomm, go back 5 years. And there you go. You're down here in the 60s area, so that is about as low as it's been since about, going back to 2018, something like that, well, at least a year ago. If you notice, a lot of the tech stocks have not fallen the same way. So a lot of people think that if you're going to start taking a shot here, rather than buying the ones that have been beaten up the most, some people think the ones that have been beaten up the least are the ones that you should look at, which would be tech and growth. So keep that in mind because that seems to be the mantra. Although some people also believe that until tech and growth give up the horse, we're not really going to see the bottom. And when you do see them give up the horse, then basically that would be a very good sign that capitulation has probably occurred. So a couple of schools of thought there. Either A, they're too strong even to get hit during this type of environment, or they're hanging on for dear life. And if we go down on another leg, people need to sell their winners. So they're going to have to sell some of these things in order to pay off some of their losers. But either whether they have another leg down and get caught in the storm much more than they have been. Some people do believe that when we come out the other side, the 5G and things like that, and the tech and the growth stocks are going to be the ones to help us. Let's go over a few more real quick here. We got SWKS. And again, SWKS. All right. And on a 5-year basis, down here, it's been as low as 73. Last time it was in this neighborhood was back in 2019. So you can see a lot of stocks are down at 2016 levels and 2011 levels, and some even below 2008. But these guys are definitely not being thrown out with the bathwater. That is either fantastic and it's not going to get hit as much. I mean, obviously it's been hit. That's a discounted price. So you got a discounted price. So you might not want to get greedy. Or again, you go in stages, just like we were talking about. The 2200, 2300 area, whatever. You do a little bite, 2000, you get it. You take a bite, 18, 1700, you take a bite, and then you hope it doesn't turn into anything worse than a 60% drop on the S&P. All right. What else you got here is you got Marvel, MRVL. And then you got Xilinx, XL and X. And you've got Intel, INTC. And you've got Broadcom, AVGO. Let's look at Broadcom. They all are very similar in that what? They got hit. They all got hit. But they have held up much better than your industrial sector, your materials sectors, your banking sector, financial sector, and all the rest. So the bottom line is, these are all discounted. You're getting a deal from where it was, no doubt. But, this is down to 2018. So most of these have held the 2018 December lows or July lows or whatever. Okay. Other ones keep an eye on is QRVV and TMUS, which is your T-Mobile. They just got a deal going with their deal closed with Sprint, and they're issuing debt. So T-Mobile's at 85. Again, they're now, well, when you combine both of them, if you look at them, now they're in the same league with, AT&T and Verizon as far as the size of the firm is concerned. And that's why they thought it was a good deal for people. And this thing hardly backed off at all. You've gone from a high there of 98, and then the lowest bin is 75. So, you got a 25% discount on the drop, but it's back on the bicycle now because of the combined companies have definitely gone through this week on that. Okay, on cloud computing, let me read off some for you. Obviously, Microsoft, Amazon, Google. You've also got Adobe, ADBE, and then you've got Alibaba, and you've got IBM, and Salesforce, CRM, and Oracle. And for your cybersecurity, you got Cisco, CSCO, you got CHKP, CYBR, and PANW. So, and then for your infrastructure, you've got American Tower, AMT, Crown Holdings, CCI are two of the big ones for the towers. And so that gives you some idea on some of the things that are available out there. There's obviously a lot more to talk about. In my weekly update, I have more time to go over more specifics. So if you'd like to get more specifics on what I'm watching, my opinion, my observations, just get into the queue and you can get it on a weekly basis. With regards to other ways of looking at things now, one thing would be dividends. And again, you got to be careful with dividends because, in Europe, they've told all the banks not to do any dividends and they're telling everybody not to do any dividends. And there's been a lot of companies here that have slashed their dividends. Why would they slash their dividends and buybacks? Because that's their cash going out the window. That's how they got in trouble in the first place, right? In other words, what? When UAL and American Airlines and these other guys, Delta, buy back their own stock, and then the market tanks and nobody's flying and their cash flows out the window and they spent all their cash on buybacks, that's the knock at the door. Why do we have a knock at the door? Because they spent all their cash. They have no cash. So who's got cash? The Fed. How they have it? They print, they issue debt, they do all kinds of behind the back passes. Who knows what they're doing? Bottom line is what? There's a lot of liquidity being just thrown out there, and these bailouts are all about what? They spent all their cash flow got pinched, and bingo, they want money. Now, there are companies that may be able to keep up their dividends, and I'm going to just go through a few of them right now. You got Jpmorgan. Now, again, the risk here is that if the banks, which are now allowed to expand their balance sheets, their balance sheets now in play again because their leverage is only like 10-1, where during the crash of 08, it was 32-1. So the Fed is saying, let your balance sheet get a little wild or whatever that means. And also, they're not having to do a loan examinations with this CECL thing. Where you're supposed to go back and look at your loans and reevaluate them when people's finances have changed. Well, every loan on every bank's books has got a different type of borrower now in this environment. So if they really made CECL and for CECL, where they have to go back and look at the loans, that would cause a big problem. That's been suspended as well. Now, Jpmorgan, some people think is best in class in the banking sector, and it is at a discounted price as well. Its high point up here is like 140, and it went as low as about $80 or something like that, 83. And it pays currently, it shows 427 yield. Johnson & Johnson, J&J, 295. Telephone, 742. That seems a little bit high. Maybe they'll have to cut that. Intel, 254. Verizon, 465. The big ones are these oils. Do you think Exxon and Chevron are going to come out of this thing? Do you think that this oil glut is going to change, and that Saudi has said they're going to pump all the way through May if they keep that up? If not, Exxon is 927, which seems awfully high, and then Chevron is 754. In the drug area, Merck is 331, 3.31 dividend, and Pfizer is 4.79. Philip Morris is at 658. So you got a lot of stuff going on there for dividends. How about growth? Well, growth is generally in what tech and things with 5G and cloud, right? So Microsoft, Apple, Amazon, Google, Intel, NVIDIA, Salesforce, Visa. I mean, we're going to go back. If we're going to go back to spend money, they do it through Visa, Cisco Systems, Qualcomm, and Alibaba. So there's a lot of different ways to go as far as that's concerned. I'm going to show you something here, another thing here that I look at, which is CEF Connect. And basically, this will give you an idea on the liquidity problems on some of the closed-end funds. Just to give you some ideas. CEF Connect gives you the details. So, there are things called floating interest rates, which basically are like leveraged loans maybe and things like that. Well, Naveen John Hancock has one, and just look at here. You put in the symbol up there, and then it gives you the 50-week share price, current, and the NAV. So this stuff is being priced at 716, and the net asset value, meaning the liquidating value, is 832. which means it's trading at a discount of 14%. The price is trading at a discount of 14% to the NAV. That gives you an idea of the illiquidity going on in some of the income products. Another one that is giving a little example of illiquidity is PIMCO's got an energy fund. And can you see it is 548 is the share price and the NAV is 640. So it's at a 14% discount to the NAV. Again, that's in the energy sector, and it shouldn't be too shocking that that would be trading at a discount. Other ones that I wanted to give you a little bit of a idea on is another income fund here, which is a credit and mortgages. That's trading at a relatively smaller one. But look at the 52-week low. That probably happened last week. The price went down to 1346, and look at that discount, 20% discount to the NAV. So for those of you who would like to, and again, there's special risks and things you got to know about closed-end funds, but again, it also works on buyers and sellers. And if everybody wants to get out of something, right, then the share price may drop down further than the NAV, and these are examples of that. And that could be a value if things stabilize and turn around. Because obviously, if you buy it at a 20% discount at $13 and it goes back to $15 and the discount's only $4, and obviously that's an example of that, that was a good buy down here. But you had no assurance it was, so you took a risk, but you got paid on the risk. Sometimes you don't. But this is where you find the information. And this is where, that can be very helpful. Another platform I like to go to is Bar Chart. And on barchart.com, I'm going to give you a little bit of an idea here on, excuse me, some of the inexpensive stocks that have big names on them. Well, let's just take a look at the price of the GDX, because this is the gold ETF. And you punch in the GDX there, you can see the stock market's up a little bit. Oil's getting a bounce because of China supposed to be buying, and they're hopefully having a meeting with these. Okay, this is the juniors, the gold juniors. GDX is the larger cap, and this is the gold juniors. Hang on, let me see if I can get a. Gold juniors are up 264 right now. Going to go to the full chart so you can see the whole thing. Push the screen up a little bit for you. Yeah, computer's working a little slow, but anyway, this is a platform and a website to go to where you can get all types of prices, and they give you technical indicators and stuff like that, which is very helpful. And let's just see here. Okay, looks like they're going to give me the chart finally. Oh boy. Okay, now here's the deal. Say you want to add a moving average to this thing. You simply go over here to the study, and then you look at all the technical indicators you can put on there. You see all those indicators, right? Very helpful. And just say you want to put a moving average in there. And say you want to look at a shorter term average here. You can put any period you want in there. Let's just say we're looking at the 10-day. Get an idea if there's a real turn going on here, because this stuff had come down. If there's a turn here, it might be interesting, because gold is above 1600 again today. Yeah, so this would be an indicator, on the gold juniors, that obviously you had a big drop from 40 bucks all the way down to 15 or whatever it was down here. And now you can see the moving average on the 10-day is trying to turn. And if this thing can get above, it looks like if you can get into the 26s, and certainly if it can take out 30, That would be very helpful. And then this moving average, which has turned down, obviously that would start bleeding to the upside. So I would keep an eye on GDX and GDXJ to see if in fact it's starting to make a turn down here. There are many people who think that the gold has a big future because of all the printing and all the stuff that's going on that way. So if that's in fact true, then obviously GDX and GDXJ might not be two bad places to look. But anyway, you can put anything in here you'd like, and it'll give you an idea on the 10-day trend. Let's see if we can get the S&P up here for you guys to take a look at that. Okay. Yeah. Well, actually, I tell you what I would like to do, because we've already talked about let's look at emerging markets. See if they'll give me that. There you go, emerging markets. Because some people are thinking that the sovereign debt over there, Vanguard has a international fund that does debt in emerging markets, and that is yielding quite a bit now, as you would imagine. And basically, this thing used to be in the 40s, and let's see if there's any sign of any kind of a turn down here on the emerging markets. Okay. I guess with everybody home, the whole world's on the internet, and obviously it probably puts a strain on the speed of the computer. And as we're coming to the top of the hour here, I'll just go over this real quick if they'll give it to me, and then I'll just give you a quick overview on some of the things that I'm looking at right now. Yeah, a little bit of a turn in the international markets. If you got above 36 on EEM, it looks like it's trying to make a bit of a turn. So you could be getting a bit of a bounce. Again, they're printing a lot of money to throw at this thing. So, basically, that could be the situation that could be helpful. Let me just give you a quick idea here on a couple of other things. In the bond market, again, obviously the TLT went to a very high price of 180. I don't know that it's going to take out that number for a long time. So keep an eye on that. People that are looking to get income, there are ultra short-term funds and also short-term funds that have lower duration. You got to look at your credit risk. Whenever you're buying anything for income, there's two things to worry about. Duration, which is how far out you're going, because that'll be interest rate sensitive. Interest rates were to pop up, they're going to damage the duration. Interest rates go down, duration is lovely. The second thing is credit quality. So you got to watch your credit qualities. Again, I try to cover these things each week in my thing. So if you're looking for income, I go over that kind of stuff. With regards to the US dollar, we all know the US dollar was in a trading range between about 100 and 95. It busted above 100, and now it's come back in. My feeling is if it gets above 105, you could get a very serious stampede into the dollar. And if they continue to do all this easing, and we go into a very heavy recession, then the dollar could be vulnerable if it broke under 95. So my two key numbers on the dollar index, DXY, is going to be 105 on a breakout to the upside, and 95, a significant drop to the downside. Otherwise, it's meandering, which it's been doing for a couple of years. As far as crude oil is concerned, I thought that 15 to 20 would be about as worse as it gets. And I think if the Saudis, everything, all the ships are full. So they can't even store the stuff. They're renting it out. The government is renting out storage. So we got more supply than you could think of. If they do cut back the supply and we get a second half real burst in demand, it's possible because the moving averages are up in the 40s. that you could pop from 15 to 20 higher towards 30. It's possible. And if that happens, obviously that could be very good for Exxon and Chevron. Other things that are going on, we talked about the gold. Listen, the gold to me is as very simple as this. If you take out 1700, you're on your way. If you can't take out 1700 and it rolls over because deflation is coming into the picture, and if it ever takes out 1450, then you're going to accelerate to the downside. So gold is in a real, I call it high noon. It's either one thing or another. You're either going to break that 1700 and you're going to get a deacceleration, or it's going to find out that deflation and a strong dollar is too much. And all these people that have gotten very bullish on gold, they're going to regret the day they got too bullish. And those mining shares not being able to get above GDX 30 is also concerning. So keep an eye on 30 GDX and 1700 on gold. If it gets above those two levels, then I think the party's on. The last thing is agriculture. Again, I'm watching soybeans. They haven't done anything. Most of these agricultural products are dead. But if you do get above 950 and 10 because if something occurs in the grain market, then that could be a very good situation to keep an eye on as well, because they're very out of favor and they're off most people's radar, which means there's not a lot of participation, which means if they start turning, there's a lot of people who could join the party. So just like when we're at 3,400, there's not many sellers up there. So if it starts turning, a lot of people can join the party. And that's how you go from 3,400 down to where we are. Again, I have a weekly update that I'm more than happy to send out. All you need to do is go to optionprofessor@gmail.com and say you'd like to be put into the queue. I'd be more than happy to share my thoughts, my opinions, and my observations with you. My time right now looks like it's up. Again, if you'd like to get more information or get the weekly update, again, optionprofessor@gmail.com. You guys got a great list of people you're going to talk to today or listen to today. So I wish you all well. And again, look forward to having you guys get the weekly update. I'm Jim from Option Professor, and have a great day.